In today's video, we are speaking to one of the most successful natural resource and commodities investors in the world today. That is one of my mentors and now become one of my pretty good friends, Mr. Rick Rule. And we're going to be talking about what are the best ways you can prepare yourself, what's happening in the macro environment, and some investing philosophies that can really help you. So make sure you smash the like button on this video over there. Send this out into the YouTube universe. Subscribe and bell notification right over there to get notified for future episodes. Give me a comment right there down below. This is Rick Rule Rules right there down below. Rick Rule Rules. Last but not least, thank our sponsor, which is First Majestic Silver today. So we want to thank First Majestic Silver, one of the bigger and more well-known silver producers in the world. We want to thank the CEO, one of my good friends, Keith Newmeyer. So be sure to check out First Majestic Silver. And good to see you.
Pleasure to be with you, Jake.
So where do we even begin, Rick?
Well, that's a good question. I guess it depends on where you want to go. There's all kinds of things that we could talk about today. It seems, I guess the easiest place to begin is the sort of juxtaposition between the investing public's actions and the state of the economy, but we can really go anywhere you want. I'm struck by the relative complacency with which, in particular, American investors are dealing with negative real interest rates, dealing with the fact that Americans hold trillions of dollars worth of bonds, where their yields are below the rate of inflation, which is to say, trillions of dollars are invested in the sector where your loss is guaranteed even before credit quality. The fact that people are sanguine about guaranteed risk is a real surprise to me. I have to say, after 45 years in the investment business, the idea that somebody would buy, as an example, a US 10-year treasury, get paid 1.65% in a currency that's depreciating by at least 6.5% a year. In other words, where you lose almost 5% a year compounded for 10 years, mystifies me. But that's what makes a market, I guess.
Now, there's a lot of people very afraid. Are we in a stock market crash? What's the future of the economy? You know, of course, stock markets are still, even though they've corrected, they're still record highs, but we've got this inflation that doesn't seem to be going away. Recently, there was an article dubbed The Great Resignation, that there's an incredible amount of people quitting their jobs. What do you make of this moment in time that we are in?
Well, it's certainly an interesting moment of time. We could say it's unheralded, but my suspicion is that every year I've ever lived has been unheralded. So let's try and take the questions in sequence. I think there is a confidence and a complacency in society. And I think I can explain that because in the period 1982 to today, we've lived through the 40 most benign years in economic history, really a Goldilocks era. We benefited from incredible advances in technology that made capital more efficient. We benefited from globalization, foreign trade, which brought down costs. We benefited demographically from the baby boomers coming of age and becoming producers as opposed to consumers. And we benefited from very, very, very low interest rates and a declining cost of capital for 40 years. You can't imagine a better set of circumstances. And so I think the behavior of investors and taxpayers and everybody else was fairly positive and fairly constructive, which is great. We lived through 40 great years. My suspicion now, however, is that we've entered another period, which will be somewhat less benign. I'm not trying to say, like Doug Casey, that we're entering the Greater Depression. He's better at stuff like that than I am. But I think we're coming into a period where the tailwinds associated with ever lower interest rates is over. You can't take interest rates too far below zero in a real sense for too long, or otherwise people stop saving and there's no supply to lower interest rates from. We're in a period too of economic nationalization where the benefits of global trade are declining. We're entering the period around the Great Resignation and around employment where there are lots of jobs on offer, but the jobs require skill sets that the population doesn't have, or else the jobs have structural payment levels that the workers can't afford to accept. Think for yourself, Jake, what it would be like to support yourself and your family where you are in Utah if you were making $15 an hour or $16 an hour bagging groceries. You wouldn't take that job either because you couldn't support your family. So we have a whole range of circumstances that we have to overcome. And I think that everybody's expectation of the future has to be somewhat less rosy than their expectation in the past. That doesn't mean that there won't be wonderful ways to defend yourself and, in fact, make money on the volatility that's going to come up. But I suspect that the benign economic climate that people have become used to is going to change and change fairly rapidly.
Yeah, I was just getting my internet set up here at my office that I was just telling you about that I got set up, and the guy that was setting it up asked me, what is one of these costs? And I told him, and he said, no, thanks. I'll rather live in my truck. And I said, are you living in your truck right now? And he said, kind of. I'm working full time and I can't afford anywhere to live here. And where I live it's relatively cheap compared to a lot of places in America. Of course, not the cheapest, but that kind of struck me. And I'm not sure what the answer is to that. I try not to delve in it too much now and trying to be more, ask myself, what would Rick Rule do? Like my bracelet, what would Rick Rule do? No, I'm just joking. But what I've learned a lot from you is really just there's a lot of things you cannot control in the world, and there's a few things you can. And so if we focus on what we can control right now, where are you putting your energy? You've talked for a while about your belief that, um, looking at the arithmetic, you expect some form of a whether it's a crash, correction, whatever it might be. Is what we've seen recently that, or are you expecting more to come? Are you buying now? Or are you waiting to see if there's further issues in the markets before you enter in fuller force?
Boy, Jake, you ask big questions. So let's unpack that. I think if interest rates go up, that equity prices and bond prices go down. I don't know how much scope there is to raise interest rates. I think in the very near term, there is at least enough liquidity in the economy. There's lots of cash on the sidelines that the Fed can afford to let interest rates go up some. And if they do that, if they're willing to pay the political price of higher interest rates, which I think they should, I think that in the near term, the dollar strengthens, and it may well weaken dollar shorts like gold or silver. Wouldn't surprise me to see that happen. I'm no economist, so I'm not saying it's going to happen. But increased interest rates reduce bond prices, and they reduce share prices, both because they increase the cost of capital for companies, but also because they make deposit products, which would pay higher interest rates, more competitive with the dividend yields on big stocks. So if they're able to raise dividends, one would expect that would hurt the equities market a little bit, hurt the real estate market a little bit, and hurt the bond market, although it would probably strengthen the US dollar. Looking further out, Jake, since you prefaced the question around arithmetic, let's think about how much higher interest rates would be allowed to go politically if the political class doesn't lose control of markets. Traditionally, the US 10-year Treasury has traded at a slight premium to the CPI, which is to say that it has offered at least a nominal real return. With the CPI, the stated rate of inflation, running at about 6.5%, if you took interest rates to their historical mean, that means the US 10-year Treasury would be yielding something like 7. Imagine the impact on federal, state, and local governments if their interest charges quadrupled. I think that would be an interesting set of circumstances, to say the least. Further, traditionally, the 30-year fixed mortgage rate has traded at a slight premium to the US 10-year. So if the US 10-year went to 7, it would suggest that the 30-year fixed would go to 7.5 or 8. Imagine what would happen to home affordability or home sales if the 30-year fixed went from 3.4 to 8. I think the economic dislocation that we would face as a society and the political dislocation that we would face if interest rates returned to market would generate truly interesting economic sets of circumstances. I don't think that the political class will allow this to occur as long as they stay in control. The whole question that you asked revolves around confidence. Is the confidence that the big thinkers have obtained as beneficiaries of 40 years of benign economic climate going to allow them to continue a circumstance where you punish savers and reward spenders with negative real interest rates? And the honest answer I have to that question, Jake, is I have no earthly idea. Now, in terms of places to put my money, that's a very different question. I see wonderful, literally wonderful opportunities out there because everybody seems to be concentrating on the same asset classes. And I don't want to own those asset classes anyway, so I'm not competing with anybody. We've talked before about the convergence of, in particular, negative real interest rates, debt and deficits, and market share being over the next 2 or 3 years, maybe not 2 or 3 months, but 2 or 3 years, very good for precious metals. So I'm certainly there. Of more immediate interest, Jake, you'll recall the first time you interviewed me 3 years ago, I was a wild uranium bull. Then 8, 9 months ago, I turned into a uranium equities bear because they got overpriced. The uranium equities indexes now have fallen by 45% in 6 months, at the same time that the uranium price has increased, and at the same time that the physical oversupply has been reduced by the Sprott Physical Uranium Trust. At the same time, too, that the political winds in Japan are favoring Japanese restarts in 2022. In other words, right now, while there is evident upside in the uranium market, the uranium stocks are in free fall. This is a wonderful circumstance for me. So I bought my first new tranche of uranium stocks last week, was rewarded by a prompt fall in the price of the uranium stocks. So I'm looking at adding at least 2 more tranches. I see a potential downside in the uranium equities from here of 20, 25% perhaps, but I see an upside of 250 or 300%. Think about the juxtaposition between a 25% downside and a 300% upside. It's wonderful. Sidebar, Jake. I'm doing Uranium Investors Boot Camp, which we'll talk about more about later in the show, March 19th. One of the lovely parts about a new virtual video world is that you can produce content on a timely basis. And this decline in the uranium equities prices in the face of the bullish outlook for uranium has me so incredibly excited that I'm putting what I humbly believe will be the best masterclass on uranium investing available into the market March 19th. More information through Jake Ducey.
Yeah, we'll go ahead and we'll link that right there down below. And on the subject of uranium, while equities have fallen and there's a fear of market crash and whatnot, the price of uranium held pretty firm. What is your make on that? Whereas a lot of things were sliding and the physical price of uranium did not seem to move down in correspondence.
Well, I think the uranium price might have got a little ahead of itself as traders began to front run the Sprott Physical Uranium Trust. You know, make no mistake, what's changed in the spot market in the very near term is the fact that the Sprott vehicle was enormously more successful than anybody, myself included, thought it would be, raising $1.1 billion in 4 months on the Toronto Stock Exchange. I had anticipated that Sprott would have to obtain a New York Stock Exchange listing before the pace of capital flows would be this great. And the consequence of that was 22 million pounds or something like that of overhangs removed from the market. And we began to get a circumstance where the Sprott Trust was raising $20 million a day. And physical traders were front running the Sprott Trust. In other words, physical traders were taking the price of uranium up, knowing that they had an outlet in the face of the Sprott Physical Uranium Trust. The price of uranium moved from a pre-announcement price of $18 a pound to as high as $52 a pound, which is to say better than a doubling of the price in a very, very, very short period of time. And it just simply got ahead of itself. What you're seeing now, the backtrack in pricing from $52 or $53 a pound to $43, $44 a pound, is a normal, natural, healthy retrenchment. My suspicion is that even without a resumption of massive buying from the Sprott Physical Uranium Trust, that the pace of Japanese restarts, which I now believe will commence in 2022, will generate between 10 and 12 million pounds of additional demand annually, wow, separate and apart from the Sprott Trust. And I believe that when, as, and if, maybe we should just say if, Sprott is successful listing the trust on the New York Stock Exchange, given that about 90% of the volume in the other Sprott Trust products takes place in New York rather than Toronto, that it is not unlikely that the listing of the Sprott product on the New York Stock Exchange, giving more American retail investors the opportunity to participate in the uranium market, we'll see upward pressure on the uranium price too. But really, I believe that Sprott has received too much credit in the near term for moving the uranium price up. You need to remember, Jake, that the uranium price moved down post-Fukushima. Many people don't know that even without Japanese demand and German demand, that global demand for uranium now on a worldwide basis exceeds what global uranium demand was pre-Fukushima. The near-term catalyst, of course, is the resumption of the Japanese nuclear fleet, which does two things. It takes inventory away from held for sale and moves that inventory into held for fuel, even while it increases the global consumption of uranium by 10 or 12 million pounds a year. If you put that on top of the increased demand that we're seeing from an absolute boom in new plant nuclear construction worldwide, it tells me that the next 2, 3, 4, 5-year outlook for uranium is rosy, really rosy, and particularly rosy given a 45% decline in the price of equities. In other words, the circumstance is brighter, the timeframes are shorter, and you get to enter the sector effectively at a 50% off sale. Pretty attractive set of circumstances from my point of view.
Okay, so talked a little bit about uranium. You talked a little bit about gold mining stocks. One of the things that I've learned the most from you that I have to admit, I'm not sure if I thought you were wrong as much as maybe I didn't understand you at first. The first time we met at your office and you were just giving me some mentorship and I was telling you about my business and my financial situation. And you told me I didn't have enough cash and I should have more cash. And to be honest, like I said, I'm not sure if I thought you were wrong, maybe as much as I didn't understand you. And I've recently I've re-examined what you said to me and the advice that you gave. And I was wondering if you could touch a little bit on that. While we're having record amount of money printing, incredible moves in inflation, seems like everything's going up in price. Is it still important to have cash? Why is that important? And why did you give me that advice?
Jake, I've pondered how to teach that lesson a lot. My inability in the first year that you and I knew each other to explain my position in cash bothered me as an educator. And I've thought about it. So thank you for asking that question. Cash is a tool. When you buy a new video camera, it costs you something, but it allows you in the right set of circumstances to employ it to make more money than it costs you. Cash is a tool. Right now, holding cash costs you. If you own cash and you have it in the bank, maybe you get paid 50 basis points. Well, your purchasing power is declining by 6.5% a year. So cash is costing you 6% a year to hold. but it's a tool. There have been 4 or 5 times in my life where broad asset classes have fallen by price 50% or more. And if you have the cash in a liquidity crisis, you can take advantage of the circumstance rather than being taken advantage of. So I consider the deterioration in purchasing power around my cash to be an option payment, an option premium. In other words, the charge that my purchasing power takes in order to preserve the optionality I have in a currency or credit crisis is one I'm prepared to take. I remember back to 2008, 2009, broad classes of assets fell 50, 60, sometimes 70%. And as a consequence of the fact that I had a lot of cash, that cash and that experience gave me the courage to take advantage of the liquidity crisis rather than being taken advantage of by the currency crisis. The consequence of that is that my portfolios were probably up by 100% in 12 months following that liquidity crisis. And I would urge you to hold cash for precisely that reason. But there's another reason to hold cash, Jake. Maybe at your age, you wake up feeling every day feeling good, and you sleep well every night. I don't. Cash is good for the nerves. I've had periods of time in my life where I had lots of cash, and periods of time in my life when I didn't have very much cash. And I just have to tell you, I felt better about things when I had lots of cash. I slept nights. I feel the same thing about gold. It's interesting. It's the largest shareholder of Sprott. My life is leveraged to gold. If the gold price goes up, I do well anyway. But I still hold physical gold. I hold physical gold because I consider it to be insurance, good insurance. It allows me to sleep nights and stay calm. Things of the 69 years of age are real treasures.
How much cash should one hold? Is it, some people say, well, you should have 12 months worth of expenses. I mean, let's say someone, to make this as useful of a conversation as we can for someone listening to this, how does one go about figuring out how much they should have?
I don't think there's a one size fits all answer, Jake, but I think for you, somebody who earns substantially more than he spends, and somebody who by now has spent 3 years studying financial markets, and somebody who, like yourself, wants to make enough money, not merely to survive, but to thrive, that you need to have a lot of cash. You can afford to have 15 or 20% of your portfolio in cash, because the idea that you're losing 6% of 20% is an acceptable cost to you. The circumstance could happen, Jake, in the next 2 years, where there's a crisis of confidence, and the S&P 500 could easily fall by 50%. Leaving apart fringe commodity assets, you could buy the finest companies in the world at 50 and 60% off. You could have a once in a generation opportunity to improve the fortunes of the Ducey family. And the idea that what it costs you to have an option on taking advantage of a liquidity crisis would be a 6% diminution in the purchasing power of 20% of your portfolio, which is to say sort of a 1.2% per annum portfolio cost. That's a minimal price to pay for the ability to double your net worth in the right set of circumstances. Now, there are others of your listeners whose position is not as fortunate as you. They don't generate enough surplus cash, and they haven't spent 3 years preparing themselves mentally and fiscally to take advantage of that that situation. And they might need to have less cash in their portfolio. But certainly the other circumstance is that our prudence as a society has declined as a consequence of the fact that we've been through 40 years of benign economic climate. Anybody with a pulse can show up at a McDonald's or a Safeway and get a job. That circumstance might not be as rosy 2 years from now or 3 years from now. So I certainly believe that people, particularly young people with families, need an absolute minimum of 6 months of living expenses. I would prefer 12 months of living expenses in cash, because the circumstance may be one where your personal outcome is less rosy in the future than it was in the past, and your family isn't in a position to help you, and society isn't in a position to help you. The best place to look for your own security is your own action. And one action that you can take is saving.
Okay, so I want to get your opinion on this. I've never purchased a home. I mean, I'm in an income level where I could purchase a very nice home if I wanted to. I have far more than 12 months worth of expenses in my cash. I have my various investments and whatnot. And my philosophy has always been, especially someone that runs a business out of their house, that the situation is such that um, I'm not sure if it's made sense to purchase a home, and I'm wondering. Right now, obviously, you're in a different place of your life than me, and you're in a different place of your life than our listeners are. You're old, fat, and bald and rich, and you could buy a house and it'd be no big deal. And I'm wondering, what do you think about buying versus renting? A lot of people are jumping in to the housing market. There's a next wave of it, which is really out of fear. And we've looked at a few houses recently, my wife and I, and even the agent's pitch is a fear-based pitch. And they tell me, well, you know, you're throwing your money away on your rent, and it should be going to an asset class that will go up in value and always goes up in value. And I find myself standing alone in that and questioning my own thesis. And I wonder where you fall in that camp of someone buying a house versus waiting to buy a house, and your expectations or your advice in regards to that.
I'm not a real estate expert, and so I don't regard single family housing as an asset class. I regard it as something around lifestyle. You are a young person starting a family, and if you saw a house that you thought would have non-monetary, non-financial benefits in terms of providing stability for your wife and your family, I would say buy it, irrespective of the financial aspect, pardon me. I do believe that if you find a house that suits your non-financial needs, a house that you and your wife walk into and say, damn, I really like this. I could really be happy here. I could raise my kids until the time they left in this place, and it would be paradise. That taking advantage of real interest rates that are negative, in other words, locking in a 30-year fixed mortgage at 3.4% in a currency that's declining by 6.5% a year, means that you're buying part of the house with free money. I believe, too, that the cost of constructing new homes will continue to go up, and that will make some moat around your investments. It is common in many municipalities for the taxes and fees around new home construction to exceed $200,000 a unit before the builder has bought the lot or swung a hammer. And I think those numbers will only go up. And I think that you'll continue to see increases in supply chain inflation, which is to say that the price of new construction, I think, will continue to go up. But I would argue with you, Jake, that as a young person, you need to think also in terms of the utility. If you're going to buy a house, don't do it. If you're going to buy a home, which is very different, if you are, this is going to make me sound really, really, really sexist and get me a lot of hate, but that's okay. Women view these assets differently than you and I. Your wife probably isn't thinking as much about the financial performance of single family residential as she is a nest and providing utility for your family going forward. And that's something that I overlooked in my youth. And I have to say, I feel terrible about that. So I think that's something that you need to consider for yourself and your family. And I think your listeners need to consider that too. As an asset class, they've done nothing but go up. The expectation is that they will do nothing but go up. I think the economic outlook around the asset class is much less certain today than it has been in the past. But I think the utility for you and your family can't be overstated.
Okay, what do people not understand about making money or making more money? You talked about generating surplus cash. I've realized one thing that really changed my life was um, I was so focused on, the very meager amount of money I was making earlier in my career and figuring out ways to hack it or ways to save more or ways to cut my lattes or what have you. And I was listening to a piece of advice and the individual said, your problem isn't that you don't have the right savings tricks. Your problem is actually that you don't make enough money and you're so focused on constriction instead of expansion. And I thought about it and I said, wow, that's ever true, but I have no idea how to make more money. I don't know what to do. I was never taught it. And more importantly, I never thought about it that way, that my real problem was that I wasn't making more. And one of the interesting things I think about that from a psychological perspective is similar to a thermostat in a house. And let's say the thermostat set at 65 degrees, right? So you've got homeostasis and the home's going to pretty much stay at 65. Maybe you leave the doors open so it kicks up to 75 to bring you back to homeostasis or whatnot. Well, similarly, the average individual makes, once they hit their adult years, they pretty much make the same amount of money every year for the rest of their life, maybe a couple percent bump in bonus that's supposed to combat inflation or whatnot. But pretty much when people get to a certain level, they make the same amount every year. And I thought about that. It's like a homeostasis or a governor on a car. And it's a hard habit to break. And I was wondering if you could touch a little bit on that. How do you reset your thermostat? And what do people not understand about making money?
Well, Jake, I need to begin by saying that my audience isn't the average person. Uh, that's going to sound very arrogant. But the truth is that people self select, and people who are interested in what I have to say, people who are not offended by what I have to say, are unlikely to be people who are content with merely existing on what society provides for them. I'm much more interested in people who, like yourself, are self starters. And I think that the early education that you got around saving is good. I agree with the rest of the statement too, but I believe that you need to live below your means. What's under your control in the near term is how much you spend rather than how much you make, and taking control of your financial future by disciplining yourself to build capital is an important thing. But then beyond that, I think there's three things about money that go to your question that's useful. You make money by delivering more utility than you consume. In your particular case, Jake, when you first came to visit me, you had a self-help channel, and I went on it, and I thought, this is really good. This guy is delivering advice and content to people that will help improve their lives. He is delivering utility. And the consequence of that is that he's going to make a lot of money. He's going to make more than he consumes. Most people don't understand the connection between making money and delivering utility. What savings really are is the excess of utility that you deliver to other people relative to the amount of their utility that you consume for yourself. And you don't need to own your own business to do this. If you're working in somebody else's business, if that's the right set of circumstances for you to contribute utility, where somebody else worries about the capital, somebody else worries about the regulation, somebody else worries about organization, where, let's say, you're a plumber. If you are a really, really, really good plumber and you are indispensable to the people that you're providing plumbing services for, and indispensable to your employer, you will make more money. If you stop making more money, the plumbing contractor across the street will intervene and hire you. And your life will go up. So the first thing I need to say is understand the connection between delivering utility for other people and making money.
Before you go on to number two, why do you think that that's so hard
I
for
have
us to grasp?
no earthly idea, Jake. I really don't understand why people don't grasp that simple truth. I've wondered about how to teach this for years. I've spoken about it to old people, to young people, to middle income people, to ultra high net worth people. Uh, it's a real conundrum to me that people don't understand um, the simple concept that you make money by contributing utility to other people. People will buy from you if the goods or services that you sell are things that they value more highly than their capital, which of course that capital represents the utility that they've delivered. And the idea that people don't understand that simple connection, maybe they don't want to understand that connection.
Yeah.
I know there's a whole bunch of people in the world who, rather than spending 10 years becoming the best plumber on the face of the earth, want to buy some crypto coin that they can't pronounce and see it go from $10 to $1,000. But that's like when you're a young kid wanting the tooth fairy to be generous, you know? It's just belief in fiction. The answer is, I don't know. The second thing around money is arithmetic, simple arithmetic. People pay, as an example, in their investments, a lot of time on price information. The price of uranium is $43. The price of the stock is $10. The price information is interesting, but it's irrelevant if you don't have an opinion as to the value. If a stock is priced at $10, that's sort of an ephemeral number, unless you think that the stock is worth $20 and is selling for 10. Then it becomes very interesting. Or conversely, if you think it's worth 5 and it's selling for 10. In other words, people pay attention to information that doesn't have a lot of utility. In the absence of understanding value. Money is made on the delta between price and value, or price and future value. So when I talk to people about, as an example, uranium, I talk about arithmetic. It costs, fully loaded, $60 a pound to make uranium. With inflation in the supply chain, and also with increasing social rents and permitting, it's likely in 3 years it'll cost $70 a pound to make uranium. And if you don't raise the uranium price to the cost of production, there won't be any more. But if there isn't any more, the lights go out. So all of a sudden, the arithmetic is, if the price doesn't go up, the lights go out. What is more probable? I believe the price going up. The fact, too, that the price for entry, that is to say, the price associated with the index, has fallen by 45%. People who didn't pay attention to the arithmetic would say, well, that's awful. The asset class has fallen in price. People who pay attention to the arithmetic will say, that's wonderful. The asset class is on sale. I can buy the equation that says $45 must go to 70, and I can buy it for 45% less than I would have had to pay for that same equation 6 months ago. So arithmetic is important. The arithmetic around bonds is important too. Jake, people have a difficult time grasping that even the junk bond index, which is to say an index where you're taking credit risk, is yielding 4.6 or 4.7%, where the purchasing power associated with buying that asset is declining by 6.5%. In other words, you're taking credit risk and locking in a negative 2% internal rate of return. Paying attention to arithmetic after you've paid attention to utility, in other words, understanding the impact of arithmetic on investing the capital that you've made by delivering utility, is important. The third variable that people need to understand, and I think you're coming to understand it, is time. It's ironic that when I was a young man, your age, I was extremely impatient when I had, figuratively, all the time left on earth. I wanted, as a young man, my investments to generate positive return before the next long weekend. And I thought, charmingly, that what I want had some impact on the world. But what I've learned is that to make really big money, you need to take advantage of compounding, and compounding takes time. It's ironic that at age 69, having much less time on Earth, experience has taught me that I need to think in at least 5 or 6 year terms rather than 5 or 6 month terms. So the three things that people need to think about in terms of money are utility, deliver more than you can consume, work on your competitive advantage relative to other suppliers of goods and services, and serve your customers better. Secondly, arithmetic. Pay less attention to narrative, much less attention to narrative, and much more attention to math. And finally, make time be your ally. Get time on your side. Understand the benefits of compounding. If you do those three things, and they're hard, by the way, life will become very easy for you because you will be competing with, at most, 5% of the population rather than 95% of the population.
Interesting. So, as we come to a conclusion here, what do you think is, if somebody is listening to this interview and they say wherever they're at, whether they're in a good place financially or not so good, they just want to improve it? What's your final advice for that?
Live below your means. To begin with, most people want to be want to live rich. They don't want to be rich. Ignore those people. In order to be rich, you have to deploy capital. In order to deploy capital, you have to have capital. And in order to have capital, you have to save. Deliver more utility than you consume. When you invest, don't pay too much attention to fads. That's recency bias. Pay attention to things that are out of favor, that are statistically, arithmetically cheap, and understand the value of compounding. Think in terms of time. It is wonderful if you spend $10,000 on a speculation, it becomes worth $20,000, or pardon me, it sells for $20,000 3 months from now. But don't count on that sort of thing. Invest and speculate in a way where time is your friend, not your enemy. And continue to educate yourself. It's critical that people find purveyors of information and purveyors of paradigm, and that they continue to refresh their memory. Despite the fact that I've been cognizant of investing for 45 years, I probably work 2 or 3 hours a day, basically improving my investment knowledge and taking advantage of other points of view, particularly where they disagree with my own, testing my own thesis on a continuing basis. And I think people need to be embarked in a continuous process of self-improvement in all aspects of their lives.
So, if you're listening, make sure you smash the like button, subscribe, bell notification, give us a comment down below. This is Rick Rule Rules right there down below. Rick, I know you have a couple of things you want to conclude with, so I'll pass it over to you.
Yeah, it's ironic. I'm very busy in retirement, Jake. I'm doing a whole bunch of things which I'd like to share with your people. The first is, of course, my offer, which I always make, to rank people's natural resource investments. Anybody who goes to my website, ruleinvestmentmedia.com, if you enter your natural resource stocks, I will rank them 1 to 10. Please don't put in tech stocks. Please don't put in pot stocks. Please don't put in cryptocurrencies, just natural resource stocks. I'll rank them 1 to 10. I'm delighted to say that I am hosting this Uranium boot camp, the first in a series of 4 boot camps, which will be 6-hour online presentations. If you care about the boot camp, in the question and comment section, where you've entered, underneath where you've entered your stocks, say boot camp. But 2 more things, Jake, which are really amusing to me. Because I'm no longer securities licensed, I am able to tell people who qualify precisely what I'm doing in the private placement market. It's not a solicitation because I don't get paid. I don't charge for this. I don't get paid by the company. I don't get paid by the people. So if you are an accredited investor, if your portfolio exceeds $1 million, and you can avail yourself of private placements, they're the best speculative tool in natural resources. If you say placements, I will notify you when I'm participating in a private placement. Doesn't mean you'll be able to get into it, but you'll see what I'm doing with my own money and why. If you want to be on the placements list in the question and comment section, write placements. Finally, I'm celebrating turning 69 by backing my old friends who founded Everbank in the founding of a new bank. Many people won't remember Everbank, but it was one of the first online banks. The management team took it from zero to $28 billion in AUM. Ended up selling it to TIAA-CREF for, I don't know, 2.6, $2.7 billion, a 30x for the early investors. So we're starting a new bank with the same team. People who would like to bank in a bank that actually has equity in it, a bank that will lend against real collateral like gold and silver, a bank that won't fund 5 or 6 year obligations with overnight capital, which is to say, a bank that won't be speculating on the time spread, and a bank that will use derivatives if they use them only to hedge interest rate risk rather than an asset class. If you care about this bank, and I think you should, if you would like to become a depositor, if you'd like to become a borrower, if you might at some point in time like to become a shareholder, say bank, and I'll keep you in line for the information around our new entity, Battle Bank, which we hope to have live in June or July of this year.
Fantastic. So for everyone listening, let us know number one thing you learned from today's episode. Doing my best on these interviews to make them as practical and useful to you as I can. So let us know number one thing you learned. If there's a certain topic you'd like to see us cover in a future episode with Rick, give us a comment right there down below, and I'll be sure to source the best topics for future episodes. So let us know all of that right there down below. We want to thank you for listening today. Make sure you hit that like button, subscribe, bell notifications, what notifies you for future episodes. And want to thank Rick for coming on today.